Hello, this is Surya Saha and welcome to the Insurtech Story Podcast, the platform to spread knowledge on insurance innovation, digital disruptions and entrepreneurship. Our website, theinsurtechstory.com, and we are available on Spotify, Apple and Google. Today we are going to discuss on the topic Parametric Insurance for the crypto market. And for now, I'm delighted to welcome our guest, Edward Ryle, who is the co-founder of Neptune Mutual. Edward, welcome on board.
Hi, Surya. Thank you very much. It's a pleasure to be here.
Edward, would you like to tell our audiences a bit more about yourself and Neptune Mutual? How did you go about starting this? Firstly, from the context of crypto, which is a very recent technology that is disrupting.
Sure. Hi everybody. My name's Edward, and a little bit about me and my background. I'm interested in disruptive technologies. I'm an angel investor in the southwest of France, and I'm also an associate professor at a business school here in Bordeaux, France, where I live, and in Paris, teaching around entrepreneurship and disruptive technologies. And I've mentored a blockchain business, and in so doing networked with a number of people in the blockchain industry, and connected with Binod Navan, who is the founder of Neptune Mutual. He has a expertise in cybersecurity and blockchain, and we discussed this project around parametric cover. And I found it really interesting because everyone knows there are a lot of risks in crypto. And some people know that the adoption of risk mitigation measures is very, very limited, which is curious. So I got interested, and my background's one of sort of disruptive technologies, and I very much like the approach that he conceptualized. And so we started working together, and then we're joined by the other co-founder, Gillian Wu.
Awesome. Well, Edward, a warm welcome to you once again.
Thank you.
I think it's very, very interesting to actually learn on, firstly, insurance and crypto and how this both join hands together. And of course, there would be the incumbent insurers who would be also, moving into this market as the crypto industry grows. But the kind of risk that the crypto exchanges or the crypto wallets or the entire market that deals with crypto actually has, it's kind of little complex. At the same time, it's so nascent that we are not yet sure what kind of risk they possess, what kind of risk that we should be covering, and so on and so forth. And it's quite interesting to know that Neptune Mutual is actually trying to understand and explore that aspect and see how crypto investors can be best protected.
Yeah, absolutely. So, as I said, everyone's aware that there are a lot of risks in crypto. Many people focus on the price volatility risk, which is obviously one of the biggest issues in crypto. But it's not by any means the only risk. So you have cybersecurity risk, which again is very well publicized and talked about, and other risks as well. So there's economic risks as well. And of course, insurance, the traditional insurance industry is a industry that manages and mitigates risk. And so what traditional insurers like is to understand risk. And the way they understand that risk or any risk is by analyzing a lot of data. So using a lot of statistics and in fact actuaries to go through the data and have a very, very analytical understanding of risks. And of course, as you mentioned, the crypto market being new, nascent, and something that is unfamiliar to traditional insurance companies, it makes them very difficult just to jump into because the market's only been around for less than 10 years, and so there isn't the sort of quantities and quality of data that a traditional insurance company would like to clearly understand those different types of risks. And so that represents an opportunity for startups like Neptune Mutual.
Absolutely. Yeah. Crypto market risk, as you mentioned, is of course, a new arrival in the industry and within the risk portfolio of insurance companies in particular. So, can you tell us a bit more about this type of risk and why do we need an insurance coverage to protect our wallets? Of course, you mentioned on the price volatility part, but I would like to understand a bit more from the technical part of it.
Yeah, so in fact, as it happens, Neptune Mutual, we're a marketplace and we focus most specifically on security risk.
Yeah.
So the risk of digital assets being stolen through different types of hack. Um, and we are not, we don't have any ambitions to provide a financial hedging tool for market pricing or economic risk. So we're looking exclusively at security risk, not least of which because so Binod, the founder, is a cybersecurity expert, and so those are the risks that we know best and are most familiar with. And so that is what the marketplace has been targeted at. So very much security risk and mitigating security risk.
Right. Yeah. So,
And so,
yeah.
yeah.
So, from the technology side, smart contracts and parametric insurance, right? It seems to be a natural fit. And both are quite, if not new, but of course, with respect to the application, it is something that's being, implemented, executed in the industry very recently. So, how do you see this type of insurance to be most relevant to suit any sort of blockchain and crypto related risk?
Sure. So that's a great question, and perhaps parametric insurance might need a little bit of an introduction to some of your
Yeah.
listeners, because
Yes.
it is quite different to the sorts of discretionary insurance that we see more commonly in cover protocols at the moment in blockchain. So, what is parametric insurance? Well, it has been around in the traditional insurance sector for quite some time. And it generally is used where it's quite difficult to assess an individual loss. Um, and so the way that's dealt with is in some respects like a hedging tool. So, for example, it's used a lot in earthquake insurance or agricultural insurance. So, I live here in Bordeaux, where there are lots of wines, and if you get a frost at the wrong time of year, then all the grapes on the vine can be frozen, and then that makes them well, useless, to be honest, for making nice wine. And so, in that particular case, it's difficult to assess the financial loss of the grapes for that particular year because you don't know if it was potentially going to be a great year or not so good year in terms of the quality of the wine. So assessing the financial loss of what that wine might have been is a very difficult thing to do. And similarly for earthquake insurance, assessing individual losses is really difficult.
Yeah.
So parametric cover was designed as a means very simply to have a few simple parameters that define whether an individual gets a payout or not.
Mhm.
And it's not related to individual loss.
Right. So
And
it's,
that,
it's it's kind of a
yes,
predefined, conditions that would be given in order to, identify the trigger point for the payouts.
exactly. That's exactly right. And that helps with things like earthquake insurance, where you have one event which
Yeah.
can affect, many thousands of people. Because when that happens, you've got many thousands of people, and if they had traditional insurance, that means thousands and thousands of individual claims, which can be
Right.
challenging to go through individually. And so the analogy of earthquake insurance works quite well for crypto in the sense that you can have one event which affects many, many, many people. And in crypto, when that happens, a project gets hacked. A lot of people lose digital assets. The most important thing in that situation for the individuals involved is that their loss gets resolved and sort of paid out fast. And The other thing that is important, of course, for the projects themselves, is that confidence is restored to their project as soon as possible after an incident like that's happened. So, from the project's point of view,
Mhm.
a cover protocol or a parametric solution that enables many, many users to get paid out quickly in the event of an incident is great for them, because confidence can be restored in that project, and activity um, can can be restored fast, and that's really important. So that's why, from our point of view, I think this parametric approach is quite different. It offers fast and reliable payouts in the event of a sort of validated incident, and there's another important aspect to it as it relates to blockchain, which is that it's a very scalable approach, and particularly when used in the format of a marketplace,
Mhm.
as we presented.
Right. Yep. So, as blockchain and crypto is a new technology and there are many, many unknowns to it, right? So, from the opportunity side, such insurance is one of the priorities in the risk portfolios of majority of the insurers, at least, the newcomers in the industry. So, but considering the uncertainty surrounding this, how do you see insurers integrating such risk within their existing practices or portfolios?
Well, I guess there's a number of ways to answer that.
Yeah.
Firstly, despite the events of this year, I think that blockchain has a very promising future in terms of digital assets. Um, the trustless nature of blockchain, and the way in which that facilitates peer-to-peer transactions is hugely beneficial to both parties in a peer-to-peer transaction, and um, the ability to create smart contracts and program money, if you will,
Mhm.
offers huge opportunities. Um, the listeners will be very familiar with Web3 and the
Yeah.
different types of business models around that. So the reason for me saying that is that there are already billions of dollars in digital assets, less than there were at the beginning of the year, but that
Mhm.
I do accept. But over the next few years, I would expect the number of assets, the value of digital assets, to rise very significantly. So that's the first thing. The second thing is that current market adoption of insurance is very low, and so the combination of many billions of dollars with very low adoption of insurance, and high potential growth means it has to be a very attractive market, because there's so much upside and so much opportunity for whether it's the existing players in the cover protocol space, or traditional insurance companies that are not yet in the space, who are eyeing up the market with interest. There's a lot to learn, that's for sure. And I think as the years go by and there's more and more data and the risks can be better analyzed, I suspect that you will see, or we'll all see, the traditional insurance players making moves into this market in the same way as we're now,
Mhm.
seeing some of the big um, players in the traditional players in the finance industry starting to make a move. So we've already
Yeah.
heard of BlackRock this year getting involved, um, and and now is a good time for those sort of big entities with capital to get started and learn, and that learning is going to be very valuable for the sort of for the players that are going to make a big impact in this space.
Right. Yeah. So I just wanted to understand. Do you think insurers are actually kind of still tiptoeing into the field, or they're actually kind to offer every possible risk that comes out of a crypto, market or crypto product, or is there any sort of limitations to it that it still emerges?
Well, I guess I'm probably not the best person to ask to speak on behalf of the traditional insurance industry.
Right.
I think it's fair to say they're generally risk averse, um, and as I said, they need to know in a very sort of analytical sort of way and understand the risks before they start getting involved. So I actually think that the current players or startups have some time before the traditional insurance company really make a move in the blockchain space, despite the need for large amounts of capital,
Right.
which traditional insurance companies can bring to the space and is very much needed. I think it'll be some time before they really get involved. I mean, they are looking at the space. You know, certainly Neptune Mutual is in
Hmm.
contact with a number of major insurers and reinsurers, but there is a lot of reticence, and I understand why that is, and it kind of makes sense for the big players to be very wary of the space because it is unknown in many respects to those companies. So, I mean, we're here. There's a number of other startups in the cover protocol space, and I think it's a really much needed what can I say, tool, I would say, that's currently underutilized for different reasons. But there's no getting over the fact that there are a lot of security risks. Unfortunately, as we publish, in our blog on a weekly basis, there are digital assets that are getting exploited and hacked for different reasons. And people are aware of that. And now there is a real opportunity for them to do something about that by buying cover policies and protecting themselves.
So, Edward, I mean, lastly, any views or any thoughts that you would like to convey to our listeners if they have to understand the aspect of insurance and crypto and how their interest can be protected in the future.
I think what I'd say is that, as always, it's really important to understand as best you can what the risks are. That's the first thing. So do your own research. Nothing new there. But particularly in respect of security risks, it's not enough to be aware of them. And you know, anyone that has experienced this in the past, maybe you have a house and you've been burgled, will know that
Yeah.
after you've had things stolen, you inevitably then feel the pain and spend money on making your house more secure. But with a little bit of proactivity and thought, it is possible to mitigate digital asset risk. And most people take insurance as a precondition for either doing business or for owning assets in the traditional world. So if you have a house, you wouldn't dream of having a house without having it insured. Similarly for a car, similarly for a bank where you put you deposit your fiat. You wouldn't dream of putting, cash and savings and salaries into banks that weren't insured. And so when it comes to crypto, I think it's reasonable to say that if you've got a reasonable amount of digital assets, the same logic applies, and even more so where those risks are very real. And now there is and are solutions to protecting yourself and mitigating those risks. And when having a look at the different cover protocols that are out there, it is again important to do your own research because they are quite different. They may look similar on the face of it, but discretionary cover and parametric cover is very different. So discretionary cover requires you to make an individual loss, which then a claim which needs to be reviewed, and it's reviewed in a way as the name suggests, which is discretionary. And if you look at some of the protocols, then you'll get a feel for how often people make a claim and how often those claims are paid out. Parametric is very different. because once an instant is validated, then everybody with a policy gets paid out, and that payout happens within 8 days, so 7 plus 1. The resolution happens over 7 days, and then there's one extra day of a cool down period. So you can expect a payout very, very quickly. But it's simply that everyone gets a payout, even if you haven't suffered a loss individually.
Right.
And that mechanism is, I think, very appealing for those who are taking out cover policies. So those who purchase a cover policy that's one of the things that appeal to them. And on the other side, there are those who provide the liquidity for cover protocols, which we haven't really talked about. But again, providing liquidity to cover protocols is interesting. And there are quite a number of differences between the different cover protocols in that respect. So for us, one of the things that's very important in the design of our system is that liquidity providers have a clear and regular exit strategy. So we encourage users to provide liquidity to our cover pools, and they can do so in the full knowledge that every 180 days there will be a 7-day withdrawal period where they can get their capital out. So an exit strategy for liquidity providers is one of the things that hopefully will provide confidence. And of course, the cover protocol industry as a whole in the blockchain space is constrained by a lack of capital, a lack of liquidity, and hopefully this marketplace system, which we believe is scalable, will be one of the means that we can grow and provide more cover policies to more projects and to more users at risk.
Well, I think it's going to be very, very interesting to see how this field, grows. I mean, both crypto and how insurance, which was a couple of years back, and even now, of course, traditionally driven and quite conservative, but it's very interesting to see how it's going to cover emerging risk from blockchain and cryptocurrencies. Well, thank you, Edward. It was a fantastic discussion. Thank you for sharing your thoughts today, and a true delight to have you as our guest.
Thanks so much, Surya.
And lastly, to wrap this up, thank you for listening, and see you at our next episode. Take care and stay safe. Goodbye for now.